There's such a fine line, making money and losing money in the market.
We want to teach you the concepts.
You have to be okay with the type of trader that you are.
We're going to teach you the processes.
This is what really gives the meat and potatoes to it.
We're going to teach you how to.
The bottom line is you want to make money trading.
I can promise you that I can make you a better trader.
Join T3 Live at the Boca Raton Hotel and Resort April 26th and 27th for a free trading education event. Call now.
Good morning. My name is Scott Redler, Chief Strategic Officer at T3Live.com.
And I'm Jill Malandrino with The Street, and together we bring you the morning call. Certainly a different market that we saw last week versus what we've seen in Q1. We were up just about 9% going into trade on Friday, April 12th, and that certainly shifted on Monday last week as we saw it really led down by the transports, materials, and commodities.
Yes, the week before they started to, lead us a little bit lower. They started to weaken. So I think some traders are like, oh, maybe this will be a breakout failure, but they weren't sold on it. Then last week's action, where we broke that key momentum level, had some follow-on, selling. I think some guys are like, oh, what do I do here?
Right.
We had a bounce on Thursday into Friday, and then today we're opening up, so it's going to be a very crucial few days for the shorter term direction.
Well, I think even if you take a look at some longer term patterns like we were speaking about before, if you take a look at the 5-year chart in the S&P, we have that whole adage of sell in May. This should not be a giant surprise to traders going into Q2. We have the expectation of volatility. If you look at it just between every May and June time period from 2010, 11, and 12, we've seen that pullback, which has created a great tradable bottom as well.
Yes, well, you do have guys that, don't think we could be up 10, 11% again in quarter two. So after you have a 10% plus move in quarter one, you expect some type of corrective activity. So traders that have tried to anticipate that, who've gotten net short, they haven't been rewarded. So the question is, can this time be different? If you look at the chart of the S&P, you will see, here's the low we put in November. Fast forward, this is when we started the year. That huge gap and go. This is when we took out 1474. Fast forward to, like you said, 2 weeks ago, this was the high here. The high here was 1597. Okay, so then last week, you saw a slice of it. Okay, so this was that 1573, which was the prior breakout, and that was your first clue to maybe lighten up, use high-level stops, and then from there, we wound up coming all the way down to the 50-day. So at the 50-day, we held it. Okay, that was Thursday. I remember all of us talking about not pressing here, that coming from this area to key support should not break the first time. And then Friday, we had a little bit of a bounce back. Today, we're opening up. So the question is, what happens here? Are we developing this right shoulder, which if we are, the bear should contain this bounce in the 1563 to 1575 area, and then maybe you see some weakness for a potential break for that correction that a lot of guys would love to have.
Of course, well, the momentum guys are really dying for some volatility to come back because we need some tradable events for your day trader and swing traders.
Yeah, well, you need volatility to get better, because not everyone is just long only and they're not performing the way, like there was something this morning saying the average investor over the past 2 years is beating out the average hedge fund because they don't hedge themselves, they don't overthink themselves or whatnot. But you said, so if we look at a little bit more into history, go the last 5 years, just to see what type of pattern develops after the first quarter to help give clues, let's go back to last year. Because last year, in my opinion, was very similar. Okay, you had this, big move. Remember, we talked about this wedge pattern. It ignited. We followed the 8 and 21 day all the way into March and April. This was a really nice first quarter. So guys wanted some type of correction. So what was built here? You had your head and shoulders top, your left shoulder, your head, your right shoulder. And this came right into May. And then when we broke this area, and IBD also had us in a market correction, you saw a move down, 5% plus into June. So, here we go, fast forward to where we are now. Doesn't this look a little bit like a head and shoulders pattern like we had last year at this time, which could then break and give us a move down to maybe this 1490 area? So on a more intermediate macro, that's what we're looking at. If you go even further back, like you said, Jill, you'll see that, it has happened a few times in this time period. There's always a little bit of a, here was your last, what was it, the sell in May. Look at this one, which was a lot different. But anyway, you need to manage your risk. You need to use some type of portfolio approach or tactical approach. Right now up here, I am back to tactical. I am back to taking trades, both long and short, and figuring it out versus during this move, I was holding on average 8, 9 longs. Right now, I'm actually short the spiders, and I might have to short a little bit more on this open.
Well, speaking of composure check, let's take a look at the temperature of the sectors. We're going to kick it off with the Homebuilder ETF. This has certainly led the way, but what we're starting to see now are some cost issues and supply constraint. It's been under its 50 DMA. $28 is a very key level here, and that's what we're going to be focusing on.
Yes, you have two different trends here. You have an accelerated trend that was already broken. So if you were trading it from a shorter term time frame, if you were holding it, you probably got out of it. And now it's testing some longer term areas. So if you look here at the trend, this is the one that was put intact since June. Okay, it held above it here, held above it here, and this is the first time it's really testing it. You take a closer look, okay, which is the trend that a lot of my guys trade. You know, right here is your accelerated trend line. Where it broke, what did it do? It made new highs. It didn't matter. Here, accelerated trend broke. So I would say at this point, you know, do we get a lower high? You know, will this 29-ish contain this bounce back? Because it's probably up this morning, and if it does, then next time we come into 28, and if it breaks 28, you then finally have a move to test the 200 days. So this will be a leading indicator to watch to see whether weakness comes back here, or, you know, does it stay with the same trend as it's been in for the last year and a half?
Moving along to the financials, ticker XLF had a little bit of a bid in it on Friday after some disappointing trading earlier in the week. There have been some disappointing earnings reports with the bigger banks out there, and that is going to be key in terms of measuring composure for Q2.
Yeah, I would say the earnings weren't disappointing. They just weren't enough to get them to new highs of 2013 with the size of the move that they had. So if you look here, you'll see like in the XLF, you know, it came back, went below the 50-day, but held this, you know, this trend line. So the question is, will it take out this 18, 16 area, so to speak? Does it bounce back, and does it make its own little, head and shoulders formation? You talked about earnings last week. JP Morgan didn't respond that well to earnings. Okay, we talked about this intermediate area that broke to the downside, and now, you could draw your support here. Push through, bounce back. I would say watch JP Morgan in this 48 area to see if that contains a bounce. We might just be going sideways here. And lastly, remember Goldman opened up $1 and then just fell right thereafter. That gave us some clues too. That was right here. Okay, couldn't break above the trend line. Now it's below this. I would say Goldman Sachs is a key to watch. If Goldman Sachs can start reclaiming these moving averages here, that'll probably give us some more weakness in the banks, and that'll tell us that perhaps this time is different. We could see a more of a sustained move lower in the actual market.
Speaking of outperformance, we're going to take a look at the healthcare ETF, ticker XLV. This is up 20% on the year, and there's a lot of momentum behind it. What I'm going to be looking for, particularly in the next quarter or two, is to see if we get some sector rotation out of a name that's been up so big for 2013 and maybe moving into more laggards like the XLK, the tech sector, for instance.
Yeah, and if you look at the XLV, this has had relative strength, lots of great stocks making 52-week highs here. You look at the chart, you have two trends here. This trend is very strong. It hasn't even been tested. Then during last week's volatility, this held the 8-day. That's still really strong. And so if this group is able to go and make new highs, it's telling you that there's still places that you could have some exposure. And right now, healthcare has been one of those spots. And I will say also, just to throw in there, retail has also been one of the stronger groups, where it held the 21-day well above the 50-day, and this group looks well, and there's a lot of stocks within that group that's holding bid.
Moving back to the broader market, I want to take a look at the IYT, which is the transports. Whether it's old Wall Street or new Wall Street, you always want to pay attention to this sector because this is a true measure of global supply and demand. We've seen that sell-off of materials and commodities. We've seen the pressure that this group was under, particularly last week, and I want to pay attention to that as we expect some volatility again to come back into the market.
Yeah, and this group with the Russell and the Homebuilders broke down first, giving you some clues that maybe the S&P would come off, and it did. So now the question is, what type of bounce again? And if you look here at the transports, you will see, look at this support that it's been holding. Okay, this is one trend line that it broke below, retested. So now the question is, with this little bounce back Friday, some continuation today, will there be a lower high? Will it, just say be sold right there and be contained by this little downtrend here? So at this point, I would watch this. So if you bought here, if just say you sold when it broke this trend line and you bought back on support, this is a spot probably to book some for that quick little bounce. And the question is, does this go red today? Does this group go down, or if it's a gap and go, then you can't just have too much short on the brain.
And finally, let's wrap it up with GLD because there was plenty of action in that last week.
Talk about that break. We talked twice. Again, it's so important, your time frame analysis. Are you an intermediate trader? Are you a macro investor? And gold broke its intermediate trend line well before this. Okay, we talked about GLD at 161. If you look at the chart here, you will see this was when you had this symmetrical triangle. This is when it broke below 161, gave you a move down to macro support, bounced off it, and then look at this line going sideways. Once this gave way, what was it? Not last Friday, the Friday before, boom, you could have got out of the way. You had a little bit of time to think. You always want to be planned. And then off of this support, we're bouncing. So the question is, what type of bounce? I know gold's up today. You have the moving average right here, but you also have a gap that can get filled all the way up to 143.43. So I think we're trading GLDs like 139 now. So you have room here. I wouldn't just short the open because it's been weak, because you see the move that it's had. It could trend up to 43.44. So I would say if you're playing a bounce, I'd rather see you a seller closer to this 144 than a buyer. This will be a spot that if you covered on this drastic move to the downside, where guys are going to be looking to reshort if it could fill this gap here.
I'd also remind traders that you should also take a look at the GVZ, which is listed on the CBOE. It's not an equity ticker, but it's a volatility index, and this is vol based on GLD. That's another great forward-looking indicator that you should put in your trading treasure chest. It's just another tool that you can use to help you determine some future pricing going forward, in addition to price action. We're going to take a quick commercial, and when we come back, we dive into the trenches.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our two very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
Welcome back to the Morning Call. We're going to dive into the trenches and take a look at some short ideas, kicking it off with Baidu. Sell-side broker Maxim took a hatchet to the name last week. It's reporting this week as well, and there's a lot of concern about sequential decline in revenue and earnings coming in pretty significantly.
Yes, this one last quarter came out with bad earnings, gap down, consolidated, and then that gap controlled the movement. So that's why we look at gaps to see, are they emotional, meaning, drastic to the downside, and then everyone's like, oh, wow, that's cheap now, I'm going to buy it. If they don't get filled, they continue. And if you look here at Baidu, which has been in a very nasty trend, going back over, well into last year, here is that last gap down. Okay, this was your gap down. We had it off the charts many different times. You want to take a look here closer at the size of the gap. That means, if you're at 100 and then you gap down to the low 90s and everyone who can't buy price here says, I don't want this, that typically tells you it's going lower. And that's what it did to finally hitting some support. So at this point, I don't think there's going to be much movement here until earnings, so I would avoid it. And as we get closer to earnings, we'll figure out some kind of option strategy. But at this point, it's really priced for failure, considering that this has been a darling for the past decade and now it can't find a friend. So let's revisit it there.
Moving along to one of those names where you have to take an emotion out of the stock, we'll look at Coach, ticker COH. And I love my bags, but if a short opportunity presents itself, you have to really take it. They report on Tuesday, and what we are concerned about is slowing growth, particularly overseas in China, and we want to see if they can continue that growth trend.
Yeah, well, this one's just been a battered name. Retail's acted well. You have stocks at 52-week highs, more in like the big box arena. Mm-hmm. The specialties just have had problems. So if you look here at the chart, you will see again, look at the size of the hole to the downside. A little bit of a follow through, but since then it's just been consolidating down here. So I think the report's going to be interesting to see, is it priced in or not? I would just write down a few levels here for Coach. I would write down, if I could get my mouse to move, that 52-ish area, and then below it around 46 and see what happens from there.
All right, moving along to MPC. This one's a little bit tricky, so we're going to turn to the charts for some price action confirmation here. From a fundamental perspective, margins look great, they're growing revenue, but there's a lot of traders that are really concerned about how they're going to perform through earnings.
Right. And MPC, I would say the stock has not been something that's making new highs on traders' radar. And if you look here, you will see at the chart, it's been trending down from 90 all the way down to 75. It had a little bit of a bounce. I would say 82 to 84 is a spot that's going to have resistance. So I would see if it does get to that area, how it reacts there, and then use 75 as key support.
Our mouse is having Monday morning issues.
Yes. There we go.
Aw,
anyway.
Poor mouse. Moving along to ISRG. This has had quite a run, but again, with earnings, traders are questioning now, are they going to be able to sustain the growth and revenue that we've seen?
Yes, and this one it's been a favorite. It's been a momentum name, for a long period of time, and it feels like the trend is changing a little bit. We go to the chart here, which I don't have a mouse. I can't even show you the monthly. You will see that you have 450 as big support. You have 510 as resistance. At this point, it did gap down, and if you look there on that day, they did find some buyers, okay, and it closed off the low. So maybe the damage isn't that. Isn't spreading too much, so I would just watch to see if it fills the rest of that gap to 501.
All right, moving along to quick hits for quick cash. We're going to kick it off with Google. What we're looking at here is, are we losing some market share in the mobile space with competitors like Pandora and Facebook? I don't think it necessarily represents that much of a threat because of all the other business lines that Google has, but let's take a look and see what the chart is telling us.
Well, this was one that was chosen. Remember when Apple started to fall apart, everyone started throwing their money in Google, and it's like
the short Apple, long Google trade.
Right, but then the curse of the $1,000 price target. So if you talk about Google itself, once it started to get the top holding, it almost became something where you had to avoid. Okay, and if you look here, there goes that mouse, and when I have a new one, this one's not really working either. But you have that descending channel, okay, and it tried to break above 793, okay, which it did after earnings, so it responded pretty well. I would say at this particular point, it's got to hold above 793-ish to show some commitment to Friday's action, and if it does, perhaps it gets back in vogue, or back, they put on their Google glasses and see new highs at some point. But right now, it's in the game as one of the stronger high beta names for now. But then again, you want to see commitment to that move. Big day on Friday, might take a little time to absorb that.
Moving along to Microsoft, this is one that still is in control of traditional PCs, but it's just really lagging in that mobile PC space. Since instituting its dividend, it's really been in a trend over the last decade. What we're going to look for here is to see if they can take some of their dying businesses and really rotate into some new growthier areas.
Yeah, a lot of money started to go to the mega caps before that Goldman downgrade, because I think, again, can't get any money in the bank. These names are perceived as cheap. They're not in a growing sector, but they're making money. They have cash on their balance sheets. They provide a yield. So with that said, Microsoft came out in numbers. It reacted well to it. You want to see this gap now be protected. So if you look at it, we talk about gaps a lot. Look at that gap right around 29.50. That's where it gapped above. There was no follow through Friday, but I'd say the longer it holds above 29.50, 29.77, lets the moving averages catch up. I do think that there could be better price action from Microsoft in the second half of this year. Let's hope that that decade-long channel it's in finally gets resolved to the upside, whether it deserves it or not. It's been a big-time consolidation, and that's what we look for as traders.
But I think that's what you're going to see with tech overall, seeing a lot of, for example, look what happened with Oracle, look what happened with IBM, where some deals weren't closed in Q1. We also have the expectation that in addition to those sales being pulled to Q2, hopefully CapEx increasing a bit towards the back half of the year, and this is a thesis that Steph and I have both been working on. That's what we're looking for in IBM, which is my favorite core portfolio holding. Yes, it got killed. Yes, earnings did not come in like analysts had expected. They missed $1 billion on the top line, but they're still reiterating $16.30 on their longer term earnings. This is the name in the group that has the best margins. They're continuing to grow. They beat significantly in the services area, and that is key. Services and analytics is 80% of the balance sheet. It's high barrier to entry, and there's not many competitors in this space that even come close. It's a gift right here at 190 at your October lows.
Okay. Well,
and that's a lot to say about that.
There you go. Nice to have conviction. I would say, looking at the chart, that it couldn't find their friend on Friday. It gapped down, closing the dead lows. So to me, it's in the penalty box for, could be a week, could be 2 weeks. Last time, 2 quarters ago, we saw this. There was still another 10% to the downside. So I would say, if you're a die-hard IBM fan and you just want to go buy it, you have a better price than people last week. But overall, if you're a trader and you could watch and you could look for some kind of reversal setup, I would wait. If you look here at the chart of IBM, you will see, it closed in the dead lows right around that 190. You see a huge gap in that chart from 206 all the way to where it opened Friday. You see some bigger support to the left in November at 185. So, if you're just looking to get in, if 215 was the high area, now you're at 190, it's a decent savings. I would say if you look back at the last quarter when it came out in October, it opened around 202-ish and then went all the way down to 185. So I would say don't go all in. Okay, if you want to buy a little bit, buy a little bit, but I would say wait until it gets a little bit closer to 185 at least.
Right, and what we're looking at in options profits in particular with the tech sector, but most of the trades that we're putting on, we're looking at some time spreads, which essentially capture some of that volatility in the earlier quarters, and you're buying out the deeper in the money call in a later date, and that's really what we're looking at because of the expectation of Q2 and Q3 volatility. Let's wrap it up with Apple. This is a name that just cannot get out of its own way.
No, this one has been a level versus a level since September. I trade Apple every single day. I've probably traded it the least in the last 6 weeks. There's been times when you could look at the chart and you could see that there's been a tradable bounce, a bounce that was sustained for maybe a week and a half to 2 weeks, but then commitment just leaves. So as an intermediate trend trader, we've left. There are a lot of guys who are making a lot more money short than long, but there's been some spots that you could have, you could have chosen for some type of gain. So you fast forward to where we are now. If you're not trapped in the stock, there could be opportunity. For me, this is what I'm going to do just off the cuff. Okay, we'll see how it acts today and tomorrow. I think it closed around 390. There was a little trade there on Friday. If we get closer to 380 today-ish, I'm going to do some type of call strategy. I know everyone's saying, it's going to be 360, 355 after earnings, could be lower, but I feel like every expectation has been so battered and bruised, and since I'm not trapped in it, okay, and since there is a small chance that they do some kind of dividend, a buyback, maybe a split, and maybe the quarter's not as bad, that if that's the case, you're going to get a big gap up. Okay, a gap up where some guys who are stuck in the stock, they'll make a little bit of money back, and they're probably not going to be that happy. So for me, who's been an Apple fan, that's tried to play bounces, that we've had some nice success, especially that 435 back to 470 move or 469 that we saw a few weeks ago. So my thing is this: I'm going to throw some money at a call spread or just at the calls, either today or tomorrow, to take. That's kind of like a gamble. It's a high probability. It's not even a high probability because who knows? It could go a lot lower. But I'm going to risk what I'm okay with losing. So if all of a sudden they miss, my options will be a zero. But the next day, if the stock is down at 355, 360, then I will trade the stock. And if it's priced in, I'll make a heck of a lot more trading intraday the actual stock versus a small option play to be involved just in case there's a big gap based on what they have to say. So I'm going to risk a little bit in options on the call side, and then if I lose that, which you might, I will go and trade the stock the next day, and then that day at least the earnings risk is out of the way, and I could probably make a lot more if it opens down 30 points and acts well versus up 30 points and getting paid on an option strategy.
Well, I think it's really interesting what you said, that you haven't traded it as frequently as you normally do over the past 6 weeks. And that goes back to the first thing that we said when we opened up the morning call, is about taking a more tactical management approach to your portfolio. It's absolutely key. People that were so focused on Apple missed out on so many other opportunities within the tech space. And I think you have to be aware of that.
Right. And you couldn't, like same way with some ETFs, you could have bought the XLF to have decent exposure to the banks, or even the Russell, the transports. But if you just bought the Qs to have tech exposure, you underperformed. You had to have individual tech exposure, and if you were so hyper focused on Apple, you probably were like, oh, how could I be long the stock market if Apple goes from 700 sub 400? But the stock market started acting much better, and even into the end of 2013, if you remember, 2012, you remember, market was on the move, Apple was going lower. It was like a trade that a lot of hedge funds had on long the market, short Apple, whatever it was. But you saw the disconnect already happen, so hopefully you weren't enamored with the fact that, oh, I can't be long 8 to 12 positions because Apple's going lower. They've disconnected a long time ago. But if Apple does act better, okay, and we've seen some better action in Intel and Microsoft and some of the mega caps, then perhaps your thesis of technology in the Qs having a second half, which outperforms some of the performers now, then I think that gives it more clarity.
Yeah, I think it's going to be very, very interesting, particularly for tech into second half. And if you have names like your home builders, your financials, your healthcare names, you might see some sort of sector rotation. Not necessarily new money into the market, but you will see that shift among asset classes and sectors for sure. I certainly think so. Well, for this week, the one thing we can guarantee you, catch Scott at the end of the day every day as he wraps up the charts for us on Real Money, Options Profits, and on T3Live.com.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.